Good morning, a video morning brief of the U.S. stock market. I'm Rich Paz for Critical Point, Monday, February 24, 7:53 a.m. Eastern Time. Okay, last week a dramatic week, big drop on Friday, perpetual selling. There was just almost like no demand, and they just kept knocking it down. They'd wait a few minutes, nobody showed up to buy it, so they would take the next lower price, and it just drove it lower. Now, bottomed Friday in terms of the futures for level 4. It's possible to cash this morning at 9:30 a.m. Eastern Time. Will dip at first, put in the level 4, then catch up with the futures. And the market could bounce all day today into that level 4, but I suspect it's only going to bounce for a portion and will be swinging lower by the end of the day on into tomorrow and perhaps even into Wednesday for the level 4 intra-week swing. Now this is the S&P 500 futures 6-hour chart, and it's bounced overnight. It's going to have a little gap up. I think they're going to want to sell it. Now as we look out to Wednesday, perhaps Tuesday, that level 4 bottom would be the earliest for level 3, but there is a lower probability forecast that suggests it might have bottomed for level 3 on Friday. Level 3 is the monthly buy-sell signal. It's normally the longest, largest, most important up and down move during a month. It's how we do business in all the liquid, active, large, free markets, okay? So my guess is there's more downside coming for this level 3, and I think on the futures there's a possibility of a downside target of 59.60 and lower, and cash would be a little bit lower than that because there's still a little premium in the futures market. Now we do want to look at interest rates, okay? And interest rates are picking up, and the model is saying that's likely a level 3 bottom, and it can rally now for quite some time, and I'll explain that more on the weekly chart. For larger trends, the dollar index is trying to stage a level 3 bottom now that would hopefully will be about the latest allowed for level 2, level 1 bottoms, and the dollar can rally into summer, at least pop its head up a bit in March, during March, okay? Gold's not doing much of anything. I think it really wants to back off, consolidate. I think it's kind of high price near this $3,000 mark. Bitcoin's not telling me much of anything. I think it would like to drift a little bit lower. Crude oil can go lower, but I think it's kind of limited. It ought to bounce a little bit later, okay? Don't have anything on the hourly S&P 500 cash. It's just due for a level 4 bottom and can blip its up, and that I mean that for the S&P 500. So now let's go to the daily chart and do the normal drill here, and there it is, all the drama. There's all our sell signals from level 3s, and then some of them turned out not to be level 3s. It turned out to be something less important, yet trading-wise it was still very important. And it's also a long, drawn-out process from December trying to find far more important tops like level 2, level 1, and maybe even a long-term top, minor long-term top, okay? Increasingly, Stephen Cohen, the billionaire hedge fund manager, I think he might even own the New York Yankees, he was recently speaking that it seems like it's time for a bear market, and he said it might get ugly big, it might last a year, but at the same time he said he thought it was somewhat limited, that it wouldn't be a drastic moment, but he thinks the economy's going down, okay, and he just has a lot of problems about the tariffs and some of this Trump stuff, and there's an increasing number of people saying that, big time people, not only in hedge fund, but overall fund management, Wall Street, the banking street. They have issues here. Jamie Dimon's still unloading his stocks. That may be because he's trying to go to retirement, has other things to do with his life, but some people are saying maybe because he doesn't think there's going to be all that good of times either here moving forward. Okay, so next what we want to do is, this is down to the 40-day moving average. The 50 days probably a little bit below it. If it can't hold there, they're going to look at the 100-day moving average at about 59.41. If it can't hold there, they're going to look at the 200-day average around 5700. Okay. Now let's go to, now as far as upside today, next few days, just look for just standard retracements. I don't think it'll go any higher than a 50% up move. There are some people out there trying to buy this. They're very, very aggressive short-term traders. They think this is a yo-yo market. It can snap back like a rubber band or yo-yo and give them a pretty big up move. And then some of them are bullish and think it's just to buy the dip, but others are not. Polls show the younger investors really don't seem to care if the market's in a bubble or not. They're still net bullish. I think they're more short-term oriented, but some are saying, boy, if they're not, it may be a sign that people are just simply too bullish and the youngsters just don't know how to manage a market and they're going to get themselves in trouble. At any rate, this is the futures, and it came down to a prior target. Okay, I believe that was prior target. I've added another downside target when it can go below 6,000 into the 5,900 area. Okay, can bounce to the 5-day average, bump its head, and lower still. And I just realized for some reason this is not drawn correctly. I think we've got to give it to Wednesday or later for that level 3 bottom. Okay. And it doesn't have to bottom till next week, the latest, so it can be down all of this week. But currently, because they beat it up well enough and getting oversold on a very short-term basis, I am saying they can put a floor in soon here. Daily indicator, however, was widening spread as of Friday, and even as of today, as the market bounces, the indicator is paying no attention to this bounce. And even though it's close to oversold, that widening spread does suggest a chance of lingering near-term downside momentum the next 1 to 3 days, and the model is allowing for that. All right, let's zoom out for some of the larger trends, and on the weekly S&P 500 cash, I've set up downside targets. So basically what occurred last week is we got the level 3 once-a-month sell signal, but we got yet another level 2 sell signal, perhaps even a level 1 sell signal, perhaps even a minor long-term bear market sell signal, okay? And we're just bearish into late March on into early April for a level 2 move, and now have downside targets of about 5,900 down towards 5,800, closer to the January low, okay? And it's possible there's much more downside than that. But at any rate, down into a level 2 bottom, rally back for a level 2 top. And we may learn that's actually a level 1 and even a minor long-term top, meaning there may be more upside than I realize right now. And then it's going to pull down into a level 1 that could also be a minor long-term bottom that we get in the bear market that soon. But just realize that bottom can delay until October, and the bear market could take that long or sideways that long, okay? And we could even have a record high along the way and still knock it down. That's what we're up against here, okay? That's the way the winds are blowing in the U.S. market, all right? We have, the longer it takes to find this long-term bear market bottom, the more we can consider, instead of -7 to -11, -13% downside, the more we can consider -20 to -30%. And even though it's very low probability and really shouldn't work, it is on the table of something strange we haven't seen in like 100 years, when we could have 60% down this year. So something could really break. But I agree with some people saying we can get carried away with these downside possibilities. At any rate, we do want to look for a level 3 bottom this week or next, and that's this little line drawn right there. It's just reminding me, level 3 bottom this week or next. It can pick its head up by next week on into the following week and down again. So what it's going to do is zigzag as it goes lower into late March on into April. This level 4 upswing today can be down the next couple of days and actually have the market extending lower into that level 3 bottom. So the level 4s and level 3s will zigzag with an overall bearish bias until late March to early April. All right, let's go to the Dow Jones. And basically, for those larger trends, we'd have to have a record high to prove us wrong. And even then, as we look out in April, we'll have to throw additional darts to pick tops and sell signals anyways. It's going to take a while to work through this mess that we're going through of destroying the government and perhaps even hurting our own economy as we do it. Doesn't mean there isn't some good stuff coming out of this. It may be proper that we wreck things in order to have something better. The point is we got to focus on the wrecking right now, okay? Dow Jones, level one top, trend is over and done with. It's down into late March to early April. We have downside targets now of 43,000, thereabouts, on down to about 42,400, but it can go lower than that, much lower than that. It can go back to the January bottom. Next up is we want to look at the NASDAQ 100 cash. And I have a downside target of around 2880 or so, and then around 2530, and also back to that January low, and it may be lower than that, okay? Now, let's take a look at what's going on with the interest rates. And it is time for yet another level 3 bottom, second opportunity for a level 2, level 1 bottom. And I think we're running out of time here. I may have to allow another week or two for this to settle out. But I think basically interest rates will be higher sometime in March, back off April, and be higher still in May, June, July. So this gives us a guide to look for good news, bad news, how's the news going to flow, and then also gives us indications of the degree of the change in the news and reporting and the business and economy statistics, okay? Mag 7, okay, doesn't look good at all. I think it's over and done with, heading lower. Next up is NVIDIA. NVIDIA hanging in there, but I think it's ready to move lower somewhat, okay? And next up, we want to go and look at I need the monthly chart. I want to look at the VIX. And the VIX probably put in a minor long-term bottom. It can put a top in sometime this year. I think the trend is up for the VIX, okay? Looking at the weekly breadth, this may not be the best breadth indicator, but the percent stocks over the 200-day average, primarily for the S&P 500, it leaves me uninspired, okay? I think it's probably going lower. They're pulling money out still. Any new money coming in, they're being very careful how they play it, how they work it. And the Russell 2000 doesn't look good to me. The mid caps, small caps haven't looked good for a while, and they're right back at it. This is the equal weighted index. I think it's over and done with. It's going lower into late March to April. Okay, some of the discussion over the weekend is, let's keep in mind that Republicans have a track record that I say all the disasters in this country relative to the stock market economy occurred under Republican presidents, okay? But it may be more fair to say most, all right? And at any rate, someone put this up, so it's someone else's chart, and basically they show Herbert Hoover in the 1920s, big crashing moment. Hoover was big-time tariffs like Trump, okay? Then there's Richard Nixon, big crashing moment, inflation, gold problems, okay? George W. Bush, financial crisis, 2008, 2009, 72-year business cycle, super cycle problem. Also a major cycle problem in 1973, 74. And then the most important supercycle problem, the number one supercycle, 70 or 90% down, occurred going into 1932. So let's keep that in mind. This is some ideas from others that I'm keeping an eye on of things that can go wrong here. It looks like the economy is now slipping at a faster and faster pace, more and more negative news. Not necessarily enough to really knock the market down by large amounts and keep it down, but I think people are now worried that this is a process where the news will continue to deteriorate for some time. We are at risk of having a secondary recession this year, but it may occur over the next 2 years. And since 1980, we haven't really had secondary recessions. It is possible it's not coming back, but I'm a little concerned this is like the 1950s into the 1800s. We can have a secondary recession. A secondary recession is when we have a recession, or it certainly feels like it is, at least for some of us, but it does not become an official recession in the history book, and the government, Fed Reserve, probably will not call it a recession, but it's something close. This is some of the news put up of a lot of anger, even on the right wingers these days, of what Trump is doing. This was put out by Morgan Stanley. Carl Quintanilla put it up over the weekend from CNBC. And it doesn't show all of this, but also I'll read it off. Immigration averaged about 3 million per year in 2022 to 2024. This is just something else I'm plugging in long-term economics. I think that pretty much covers the news. I'm sure I've already forgot something, missing something, but that's your morning brief here. And I'm going to go with it that, yeah, we can get a blip up today, but I think there's lower coming this week. And then we'll probably get a blip up next week, but I think there's lower coming into late March to early April, and then we will reevaluate in terms of the rest of the year. I think there's plenty of downside potential here at this time. And there's our 6-hour chart that I'll leave you with. And past results are not necessarily indicative of future results. Have a great day. Thank you.